This is a stock analysis of Navitas Petroleum. Navitas are an oil development and production company listed on the Tel Aviv Stock Exchange. Before I start this video, please remember that I do them just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. Navitas are headquartered in Herzliya, which is in Israel, and they only have 25 employees. They operate as a virtual company where they take on loads of debt and then use it to buy stakes in other people's oil projects, and then they get revenues from those projects, which they use to pay back the interest on this debt. They have 3 projects in production, which are the Denbury and Neches project, which are both onshore, which are both Texas onshore oil fields, and then also the Buskin North project, which is a offshore project in the Gulf of Mexico. As you can see, these are all producing at the moment, and they have one project which is post final investment decision, which is the Shenandoah project, and this is also in the Gulf of Mexico. And as you can see, their current debt stacks up quite high against their current net assets, a lot of which are the oil and gas investments. And the NPV.10 of their current projects isn't all that much against their debt, but as you can see that the Shenandoah project is a massive game changer for this company. It represents a big step up in net present value with a discounted rate of 10. They also have 3 projects which are pre-FID, which are the Buckskin South project, the Yucatan project, and the Monument project, and also the Sea Line project in the Falkland Islands. Now, actually, the only reason why I'm looking at Navitas Petroleum isn't because I can easily invest in them myself, but because I'm interested in the Sea Line project. I'm interested in investing in Rockhopper Petroleum, and these will be the partners for the Sea Line project. But you can't invest in Rockhopper Petroleum unless you understand Navitas Petroleum first, because these are the guys making that final investment decision on the Sea Line project. So looking at their current production and Denbury and Neches, as you can see, they acquired 50% of Denbury in 2020, and in 2019 acquired 98% of Neches. Neches was already in production when they acquired it, and for Denbury they achieved 4 development wells in 2023, and it's now in production. And these are obviously very relatively simple Texas onshore oil projects. Buckskin North, they actually acquired 7.5% of that project in 2017, did 2 development wells, and it's been in production since 2019. So this was obviously the start of Navitas, really, but it's quite a big project of their 7.5%. The Buckskin North is actually half of their current NPV.10 value. Now, Buckskin South, the rights to this they acquired along with Buckskin North, and they did a exploration well which was successful, and they're currently in the process of preparing a development plan before getting to final investment decision. So now their post-FID project, the Shenandoah, and as I said, it's an absolute huge increase in the NVPT.10 numbers they'll have. And this is a offshore project on the Gulf of Mexico. They acquired 49% of it in 2021, and they've currently drilled 3 of 4 production wells, with the 4th production stroke development well is supposed to be produced this year, and then they're planning to go into production at the end of this year. So obviously that's a huge milestone for this company at the end of this year, whether or not they can get Shenandoah into production. The Yucatan project is actually it's still in exploration phase, and this is close to Shenandoah and it could be a future option. Last year they acquired 20% of the Monument project, and this is located also close to Shenandoah, and it's a very interesting project which I think gives a bit of credibility to Navitas. It's quite a little impressive deal because it involves the production facilities they have for Shenandoah actually lending this to the Monument project and its current owners, current operators. And in return for that, so the Monument guys will be doing some of their production using the Shenandoah assets. In return for that, Navitas will get a nice little income from that. Plus they get 20% of the Monument project, or they're allowed to invest in 20% of the Monument project, which otherwise they wouldn't have access to. And all they have to pay is 2 million on final investment decision and 10 million on first oil. Now actually they were supposed to be at the final investment decision by now, and so that's late. So this is a good news story to keep an eye on, because if it's significantly delayed, that could tell us something about the perhaps differences to the interest rate environment, etc. Or it could highlight perhaps a difficulty of getting cash, which maybe wasn't the case this time last year. Now here I've got the NPV10 of each of the projects, and you can see actually Buckskin and Denbury and Neches. Now actually the Yucatan and Monument projects are fairly small compared with Shenandoah, and the NVPT.TA of Sea Lion is less than Shenandoah, but perhaps it's comparable to it. The Sea Lion project would be partnered with Rock Hopper Corporation, and you can see the details here. 2 months ago I did a update video on Rock Hopper exploration, and actually 3 months ago I did one, and there's many more before, but in those I go into lots of detail about this project. So if you're interested in that, go and look at those videos. Well, they acquired the 65% of the Sea Lion project in 2022, and the final investment decision for that is the end of this year. So as a potential Rock Hopper investor, it really is all eyes on Navitas as to whether or not they achieve this final investment decision by the end of this year. Looking at the share price over time, and it's kind of stayed fairly flat, which is what you'd expect from their business model. Obviously when there was the Wuhan outbreak, that led to this massive drop, but that was obviously a nonsensical drop. But otherwise the share price has been fairly steady. Now actually each of these news items I've already just gone through here, but generally there has been a bit of an uptick in 2023, and I think that this uptick is related to the potential of the Shenandoah project reaching production at the end of this year. Now I'm going to go into detail with the numbers soon, but the most important aspect really is the debt. Obviously to acquire all of these assets, they've had to take on a lot of debt, which currently stands at 0.6 billion. So I wanted to take a closer look at the debt profile, and actually currently they have 209 million in terms of a bank loan, which is they're having to pay back at LIBOR plus 5%, and this is collateralized. And that's specifically for the Shenandoah project. Although they've only drawn 209 million. It's a 544 million facility. So I'm assuming from this that as Shenandoah goes to final production, they're going to have to draw up to $500 million of this facility in order to achieve that. Then the rest of their debt is all in debentures. And these are very interesting tradable securities, which kind of are a bit like bonds, and other people can trade them amongst themselves after they've bought them from Navitas. But Navitas have to pay back the debentures, the money that they borrowed in terms of the debentures, which they do at fixed time periods in the future. Plus they have to pay interest on the debentures of around normally 6%. So I think they pay a bit less. I think they pay less interest on the debentures than on the bank loans. And we can see that really we're talking about typically, 6 to 10%. I'm not totally sure, but I saw that actually the effective, although the official number is 6%, I saw something about the effective number being more like 10% for these debentures, and I don't quite understand that, but I do get that the debentures are a lower interest than the bank loan. We do have to take on board here that in their accounts we are talking about them having 0.6 billion of debt now, and to progress Shenandoah they're going to be only more debt, plus for Sea Lion to go ahead they'll have to take on presumably well over $1 billion of new debt, and you really have to factor this in as to whether you think they're going to get the final investment decision or not for Sea Lion. We know that the Shenandoah appears like it should enter into production by the end of this year, and when it does, the debt profile I think will look a lot more manageable. But it's a big question, can they raise that up $1 billion for Sea Lion to make that final investment decision this year? When I look at the history of Navitas and how successful they've been really in building up the business according to their model, I would kind of say if anyone can, Navitas can. And my kind of gut feel for this is that it'd be like a 50-50 thing, and that probably the silly thing's going to happen and there's like a 50-50% chance that they will get funding for Sea Lion. However, for me, the kind of sensible thing is, if I look at the Israeli interest rates at the moment, which I think are important, they're currently higher than they have been traditionally. Their bank loan seems to be done off actual US LIBOR rates, and again, for US interest rates, we see that again they're at historic highs. So it is actually quite the current interest rate environment has to be challenging for Navitas, and so for me, I feel like yes, they could get new debts to fund Sea Lion, but the kind of sensible thing from my viewpoint would be, if I was someone thinking of lending money to Navitas, I'd be waiting for them to achieve first oil with Shenandoah first before I felt that the debt profile was de-stressed enough that it made sense in lending the money to go into Sea Lion. So my gut feeling here really is that it makes more, there's like a 50% chance that they will go ahead with Sea Lion this year, but I think there's also a 50% chance that given the interest rate environment, it kind of makes sense that you've got to wait for production to start at Shenandoah first before you can be more confident in them achieving FID for Sea Lion. At least that's how I'd feel about it if I was going to be lending them money. So looking at their numbers, and there is a impressive increase in revenues. However, this column here is the third quarter 2023, or year to date third quarter 2023. Column here, I've then adjusted that for a estimated 2023 number. And so you see that actually there is a decline in their revenues. So presumably this means that their existing projects are now starting to decline in their production. So that's slightly disconcerting. Not really worrying, but slightly disconcerting. And it does show how they need to get success with Shenandoah to keep ramping up the revenues like they need to. Now, the financial income here, this line item makes up a significant amount of their revenues, and I found that it's actually, previously it was mostly other people paying them interest, so they have actually been paying money or lending money to some of their partners who then pay them interest, and actually there's going to be a similar arrangement with Rockhopper if Sea Line goes ahead. So actually some of their income previously was other people paying them interest, interestingly enough. And however, in 2022, that had stopped, and the financial income was actually FX effects on their cash holdings. So this is actually unwelcome noise, actually, in terms of them when you're trying to pin down what their net income is. And here I've got their net income history, and you can see actually it is an impressive one with a trend of increase in net income. But obviously, like I say, the financial income muddies the waters. So what I've done is I've got here just their revenue against their expenditure, and there is a impressive gap widening between their revenue and their expenditure. So this does look good. In terms of the expenditure, they've got their cost of oil, which seems to be under control, and the depreciation and depletion, which also looks okay. They've got a fairly insignificant amount actually going into new exploration and development, and derecognition of assets is not really significant. Their general and admin costs have ticked up now to 15 million as per my estimate for this year, or for 2023. Then we have, tax doesn't really make that much of an impact. What does make a big impact is this financial expenses, and when I look into that, that is actually interest they've got to pay on the debentures plus on the bank loans, and also you have this FX effects as well coming into that. So actually we see that the real number was 42 million in terms of the interest they're paying out and stuff, and what happens is they capitalize some of that, and so that's how you then get to this 26 million number for 2022. So I think that actually is a kind of a bit of a accounting trickery which disguises really the amount they're really having to pay out every year. And I'm sure it's all above board, and there's good accounting reasons for that. But for me, trying to get a handle on, are they in control of all the debt they have and the interest they're having to pay on their debt? Myself, I don't like that when I'm trying to get a big picture overview. And so this net income number has a lot of noise in it, because you've got the capitalization, which for me isn't really useful for my purposes, and also you've got these large numbers of, say, in 2022, 38 million of just FX effects, which come in as a positive financial income. So what I've done is I've taken away these strange financial income, which are just like noise as far as I'm concerned. And I've also gone in and taken away the capitalized costs, plus I've actually credited them the FX effects, which work the other way. And so then I've got a number which takes away all of this kind of random noise. And here we see that the kind of real picture, as far as I'm concerned, is them gaining, let's say, anything between 0 and 10 million every year. And that's kind of what I'd expect from this company given their business model. And I'm fairly happy with that. Looking at their assets, and most of their assets are actually investments in oil and gas assets. So, you know, that's as these projects have become developed, they go down onto the balance sheet as investments in oil and gas assets. This doesn't include the actual revenue they're going to generate in the future in terms of the NPV10 values. This is just the value of all the assets and equipment, capex and stuff that they have set up, which is money you'd have to expend to if you wanted to extract those assets. And yeah, so it's a very impressive build-up, and you know, this is the impressive trajectory, which is why I do say there is a good chance of the Sea Lion FID becoming improved, because you know, this is an impressive track record, and they've achieved a 10x, in fact, in their assets under management between 2019 and now. The restricted amounts, this is actually money which they've got in terms of cash, but which they've got earmarked to invest. So presumably this was in Shenandoah. I mean, this was 2021. You can see 2021 was when they acquired Shenandoah. So I think that the majority of these restricted amounts are actually related to Shenandoah. And there's deferred costs isn't really that significant, nor is derivatives. Actually, I was very interested in how much hedging they do, and actually the hedging is minimal. It tends to be only for the next year, not longer than that, and only a certain proportion of their overall assets, their overall oil production. So hedging is minimal for this company. And actually, on that subject, that does highlight a key risk for Navitas, which is the price of oil. So actually, this is Brent crude, but I think actually, despite recent fears, the price of oil is behaving itself. But there's a good chance that the oil price could drop this year. And if it does, it's kind of like game over almost for Navitas, actually. So that's an important risk to consider with Navitas. And they don't seem to hedge much of their oil production. And then they have other receivables, right of use assets, and property, plant, equipment, which don't really amount to much. Current assets, they actually have a lot of cash, but obviously a lot of that's sidelined probably for Shenandoah, and the current assets profile, there's nothing that stand out to look into, and they're not really big numbers. In terms of liabilities, and we have this whopping 0.4 billion of debentures and 0.2 billion of long-term debt, and I've gone into that obviously already with this slide. There's nothing else here that really particularly stands out worth looking into. And on the short term, there's not really anything of particular interest. In terms of the shares in issue, and they haven't actually been issuing new shares much in the last 3 years. So here's the profile that I like to do for the companies. And yeah, Navitas have a very impressive track record of growing their net assets. Now, you could actually say that the market cap is looking a bit expensive now, and it's a price to book of 2 to 1 at the moment. It has run away a bit from the net assets, but I think that's in anticipation of Shenandoah going ahead, which will see a big boost in their net assets when that happens. Of course, we can't lose sight of the debt, and they have significant debt, and I've discussed the issues around that with current interest rates. But assuming success with Shenandoah, you will see their net assets kind of eclipsing their debt. Actually, I'd have thought, particularly also perhaps if you factor in the revenues, which we should see increase with Shenandoah. Their net incomes doesn't look so impressive. Like I say, that's actually the business model for this company. It's more about taking on debt, buying assets, and then increasing the revenues coming in over time. There's always going to be lots of interest paid out with this business model, and so the actual net income isn't so important for their business model. So Navitas definitely have passed my kind of scrutiny. They kind of look okay-ish, maybe a little expensive. And when you then consider the net present value, the NPV10 of the current projects, as you can see, stack up against their market cap once you deduct the net assets that is from the market cap. They stack up quite well, and then the Shenandoah project, if I put that to scale, you can see it's absolutely a massive increase. So if you assume that the Shenandoah project is going to be successful, and it certainly looks like that at the moment, then you can see the NPV10 of that stacked up is an absolutely step change. It's a big increase, and I think that explains the recent increase in their share price. And actually, I definitely would invest in Navitas if I could, without it being extremely kind of inconvenient and probably tax inefficient for me to do so. I probably would do, but I can't. But as I say, I'm more looking into them because I'm interested in rock hopper exploration. And when we look at the Sea Lion project, it's actually not as rewarding as the Shenandoah project. And I think that's because I'm guessing, I've not looked into it, but I'm guessing that that's because even though Sea Lion offers a lot more oil, it requires more capex, I think, pre-oil, and it's probably a bit more of a challenging project than the Shenandoah is. I think though perhaps the reason why though they've invested, or they want to invest in Sea Lion, is this is the Navitas plan, which only has a phase 1 and phase 2. But once if they were to achieve this, going back to this older plan, which was the Premier Oil plan, there are then actually potential for lots of nearby expansion, what could become the development of a whole new oil territory. So I think that's the kind of added spice that makes it worthwhile for Navitas, even though it's got a lower NPV10 than the Shenandoah project. So that completes my video for Navitas. I think they are very impressive and a very good example of the capability of the Israelis. It's a classic kind of bombastic Israeli company where they're very ambitious but very effective, and I'm very impressed actually with their performance. And it does really look to me like Shenandoah could well be happening, and you really can see this very impressive profile continuing unabated actually once Shenandoah comes online. There's two risks here, which are the big risks actually you'd have to consider before investing in Navitas. One is the oil price. If the oil price drops this year for whatever reason, then it's going to, that's going to become very challenging for Navitas. And also the debt, I think currently it's going to be very challenging for them. I think they're very successful as they are now with Shenandoah, but I think future investments are going to become challenging at current interest rates. So in terms of Rockhopper, actually, spoiler alert, I have actually made an investment into Rockhopper. The reason being, Rockhopper have had some news releases this year, just recently, which made me decide to go back in. But normally I'd invest 2% of my portfolio into a risky company like Rockhopper, and I've actually only gone in 1% of my portfolio, going in half now and half later. Now, the reason is actually I'm going to do a video on Rockhopper, so look out for that. So in that video, I explain why I'm now happy to go in half, because some of the problems they had, I think they've solved. So I'll go into that in my video, but the reason I haven't gone all in is because there's still a lot riding on Navitas. Like I said, for me, I only really feel like it's a 50-50 thing whether Navitas will be able to raise the money for Rockhopper this year. For me, the common sense thing is actually you've got to wait for Shenandoah to happen first, and then their debt profile will look a lot more sensible for them to raise another billion for Sea Lion. And so that's why I've put in only half, so that I don't miss out just in case. But I won't be putting the rest in until I've either the price of Rockhopper moons because of the FID, in which case fair enough, and I just put in half I would have. So actually the best case for me would be Shenandoah going ahead, perhaps a bit late, but then us having to wait for Rockhopper, having to wait for Sea Lion, and actually so what would be great would be if we have a drop in the Rockhopper price. But then Shenandoah does go ahead, but the Rockhopper's late. But then once I saw if interest rates held up, or declined, and the oil price was hold up by the end of the year, then I think you could get Rockhopper at a good price if the final investment decision then would be late, but looking likely to happen. However, summarise all that better, plus cover the Rockhopper specific things in the video I'm going to do on Rockhopper soon. That completes my work for Navitas. I hope you found it useful or interesting. Speak to you at the next video.
I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.